Hello everyone, and how's it going? I hope that you had an amazing day and a very profitable time in the market despite the ongoing uncertainties. If things are challenging, just remember that good things like the bad will always go away. So you have seen the title and the thumbnail in the video, and yes, that's right. We're going to talk about something that is very crucial for investors like you and I, the growth potential and diversification. We're always looking for ways to have our eggs in different baskets and to benefit from the rising tide of equities when it comes. And it's precisely to fulfill such needs that we will be talking about SPY today. It is an exchange traded fund allowing investors to have exposure in a very wide range of equities while also enjoying the relative stability and security that comes in large quantity. So, we're going to take a deep dive into SPY today and to see if it could be a decent addition to your portfolio. Before today's video continues, if you'd like to see more content like this and want to see more stock analysis videos, please like, comment, and to subscribe to my channel. And check out the playlist of other stocks that I also cover on there. So with that being said, I hope that you enjoy today's topic, and let's get started. The SPDR S&P 500 ETF, SPY, has been displaying some very interesting trends in the recent days, making it a pretty interesting focal point for investors looking to make informed decisions. Let's delve into the key aspects of its performance. Over the past 5 days, the stock has demonstrated a sideways movement, nudging just 0.35% higher. While this might seem like a minor fluctuation, it suggests a degree of stability in the short term. Investors often appreciate such predictability, and it can often provide a foundation for decision making. Zooming out to the 1 month trend, SPY has been on an upward trajectory, showcasing a commendable 4% increase. This positive momentum reflects a broader market sentiment favoring the stock. Investors who eye sustained growth may also find this trend encouraging. For a more comprehensive perspective, we can also take a look at the 6-month trend, which reveals a bullish trajectory. After rebounding from the bottom of $411 back on October 27th, the ETF price has surged by more than 9%. This recovery highlights the resilience of SPY, but more importantly, of the S&P 500 and the potential for long-term gains. Now, options also play a very crucial role in trading stocks because it offers investors a strategic alternative to capitalize on market movements. In the case of SPY, key option strike prices at $489 and $495 provide insights into potential price levels. So, investors keen on predicting the stock trajectory can use the options as a valuable tool. The relevance lies in the fact that options can act as indicators, signaling where the market sentiment is leaning. Now, turning our attention into the recent trading volume, SPY records a volume of around 92 million shares a day, surpassing the average volume of 78 million. The volume is significant when factoring in the research and analysis for equity trading because it offers insights into the market activity and liquidity. Elevated volume often indicates increased interest and participation, signaling potential shifts in sentiment. Volume analysis also aids investors in gauging the strength and sustainability of such price movements. While not foolproof, I would say that analyzing volume trends can provide a limited but very valuable extent of predictability in how sustainable a price action can be. In other words, right now we're having $92 million in the current trading volume, the average being 78 million. Well, whatever the price is doing right now is likely to be more sustained, and it's going to last longer than just a blip. So if it's edging upward at the moment, it's probably going to keep doing so in the foreseeable future. The SPDR S&P 500 ETF has emerged and always been a pretty compelling investment option. Its stability, the upward trends, the strategic option strike prices make it a pretty good choice for both growth-oriented and also diversified portfolios. As with any investment, thorough analysis and consideration should be considered, but SPY does appear to be a very solid candidate indeed for those seeking a decent investment option in the current market landscape. So the S&P 500 ETF SPY has always emerged as a good option for those seeking to have a balance between high yield, growth, safety, and stability in their portfolios. But just like any investment, there are challenges that need to be addressed, both from the perspective of retail investors and the inherent characteristic of this ETF. For retail investors, the demand for high yield, safety, and stability is a driving force for sure. SPY addresses those needs by presenting an opportunity for investors to participate into the performance of the S&P 500 index, the index that encompasses a broad range of leading companies, providing a level of diversification that can contribute greatly to the stability in the face of market fluctuations. One of the prominent challenges facing the retail investors is the time constraints that often hinders in-depth research. In other words, we don't have full days and entire team after us in order to find which stock is the best. And SPY offers a solution to this by acting as a comprehensive investment vehicle tied to the S&P 500. It actually eliminates the need for retail investors to dedicate substantial time to individual stock research, providing them with an efficient way to gain exposure to a very diversified portfolio. Technical knowledge is another hurdle for retail investors looking to engage in stock research. SPY simplifies this process by offering the investment option that mirrors the performance of the S&P 500 index, which doesn't require any sort of technical expertise in order to invest in it. So this ease of access makes SPY a pretty attractive option for those who may not have the knowledge to search for those individual stocks by themselves. Moreover, the challenge of poorly structured financial products, and I want to say sometimes maybe even fraudulent financial products, where they have put all the eggs in one single basket, say real estate or the internet values back in the beginning of the dot-com bubble, for example. So these are the potential problems that retail investors may have. SPY, on the other hand, stands out as a very good alternative because it offers the potential for high growth and stability compared to some traditional banking products, not only with lower yields, but worse structuring. Like, they're not diversifying enough into 500 companies. They're maybe diversifying into one single sector, or they're diversifying into the companies who give them the most kickbacks. The historical performance and diversification do make a very appealing choice for those looking to escape the limitations of poorly structured financial offering. Despite its attractiveness, SPY, of course, just like anything else in the world, is not without challenges. The stock, or the ETF rather, is vulnerable to macroeconomic trends, meaning its performance can be greatly influenced by the broader economic conditions. And right now, we have quite a few of those big waves swarming around and lurking around. And who knows when they're going to start having an effect. Investors should be aware of these external factors that they may impact the value of SPY, especially during periods of economic volatilities. Or I want to say, any sort of uncertainty will trigger this sort of fear. And for instance, if you want to invest into a country stock, or if you want to invest into stocks, you need to have a good outlook about the future. You need to trust that the future is going to be better than the present. If we're being honest with ourselves, are there that many people who genuinely think that in 2024? Right? That would be very surprising indeed. And also, the expectation of major corrections in the market does pose a challenge for SPY, in the sense that the anticipation of the corrections can eventually become a self-fulfilling prophecy, as investors just adjust their portfolios based on their expectations, potentially contributing to an increased market volatility. This collective behavior underscores the importance of cautious and informed decision making in the face of market sentiment. So, overall, like S&P 500 ETF SPY caters to the needs of retail investors by offering a mix of high growth, safe, and diverse investments. Its alignment with the S&P 500 index provides a very accessible option for those with limited time and also limited technical knowledge to invest. However, investors must always be mindful that this stock's vulnerability to macroeconomic trends and the impact of market. So right now, the global markets are facing a complex interplay of factors that have the potential to significantly influence the equities worldwide. In this speculative analysis, I believe that the consequences of the global inflation, surging commodity prices, and declined quantitative easing, as well as the rise of inflation rates or interest rates, plus the geopolitical instabilities, are going to play a significant part. The increasing inflation rate has been putting pressures across the globe, threatening the purchasing power, raising the input costs, and impacting corporate profitability. Companies operating internationally may face challenges in managing rising production costs and also to sustain profit margins. Those dynamics could trigger market volatility as investors adjust their risk-return expectations. The upward trajectory of commodity prices, including energy, metals, agricultural products, have been having far-reaching implications for various sectors of the global equities market. The companies heavily dependent on these commodities may experience squeezed profit margins, potentially affecting stock valuations and investor sentiment. The reduction or the end of QE's quantitative easing measures by the central banks worldwide may have resulted in reduced market liquidity. So this in turn could lead to higher borrowing costs for companies seeking capital, which may also discourage investment activities or will. The elevated market volatility plus the reduced investors' appetite may also continue to occur. Now, the central banks around the world are tackling this delicate situation of balancing the inflation rates with the economic stability and, if possible, growth. Central banks opted for aggressive interest rate hikes to combat inflation. Borrowing costs for companies have been rising, which has also slowed down business activities and also fueling the market's volatility in terms of the equity prices. Now, ongoing geopolitical tensions, including trade disputes, political uncertainties, and social unrests, will inject an additional element of volatility into the global markets. Investors may adopt a cautious approach, shifting towards safer assets, impacting the equities. Additionally, the escalating conflicts may disrupt supply chains, negatively impacting the performance of international companies. Given the interconnectedness of global markets, the aforementioned factors have reverberating effects on the US equities market. Companies with significant exposure to international market may face a lot of headwinds resulting from the economic slowdowns, disrupting the supply chains and the currency fluctuations. But nevertheless, the US market is known for its resilience, and the diverse sectors may attract investors seeking safe havens. So really, the current landscape is characterized by global inflation, surging commodity prices, reduced quantitative easing, rising central bank inflation rates, geopolitical instabilities, and also ongoing lack of certainty regarding growth. While the US market may exhibit relative strength due to the safe haven status, it's going to remain interconnected with the global economic landscape. For long-term investors, these conditions may offer opportunities to identify undervalued companies with strong fundamentals and international diversification. With that being said, short-term trades should be approached with caution because of the increased volatility and uncertainty. And also, we should be careful when assessing individual companies, sectors, or regions. So, as a conclusion, the best approach to SPY right now is probably the only significant portion of your stock portfolio in this kind of holdings eventually, thanks to the diversification and the growth potential of the S&P 500. It's really important to consider the entry timing of this in your capital, since so many in the market currently assumes that we're probably going to enter into a recession and that the equity market is way overdue for a major correction in the price. I believe that there can be a slow build-up in the SPY over time, but we can also explore in subsequent videos about some alternatives that may achieve the same goal as well. So for SPY, I would say that it's the S&P 500 that's the focus. That's worth owning, not just the SPY ETF specifically. The maximum exposure I would recommend to have is around 20 to 30% of your portfolio, and long-term holding is of course the best approach as of now.